Today, we're digging into Emerson's latest earnings report, and honestly, it's a bit of a head-scratcher. You've got profits that are looking great, but sales that are, well, not so much. So how does that even happen, and what does it really tell us about the company? Let's break it all down.
So right off the bat, here's the core conflict. On one side of the coin, Emerson posts a really solid beat on earnings per share. That's the profit, right? But on the other side, it just narrowly misses its target for total revenue, which is sales. The big question is, how? And maybe more importantly, what does this actually say about the real health of the business?
Okay, so to really get what's going on here, we have to look past those two big headline numbers. Because once you start to dig into the details of this report, you begin to see a really interesting story about what's actually driving this business forward. Let's get into the nuts and bolts. Emerson's adjusted earnings per share, or EPS as you'll see it, clocked in at $1.46. That's a solid nickel better than the analysts were expecting. But then you look at the revenue, $4.35 billion, and it fell just a little bit short. So yeah, higher profits on slightly lower sales. Let's figure out how they pulled that off. First, let's talk about the good news, because underneath that revenue mess, the company's core engine, it seems to be humming along stronger than ever. We're seeing some really powerful momentum here, and it's all being fueled by some seriously strong customer demand. And here is the key number, right here. Underlying orders were up a whopping 9%. Now, this isn't just some random statistic. You got to think of this as a huge vote of confidence from their customers. These are massive orders for future projects, locking in business for months, sometimes even years to come. And all those new orders? Well, they're piling up into a massive backlog that now stands at $7.9 billion. Just think about that. This backlog is like a guaranteed pipeline of future work. It gives Emerson this incredible, clear line of sight into its revenue all the way through the rest of 2026. Okay, you might want to sit down for this number. Order growth for their Ovation Power business was up an unbelievable 74%. And no, that is not a typo. This kind of explosive demand is directly tied to the absolutely massive power needs of new projects, especially the build-out of all these AI data centers. So you start to see the bigger picture, right? Emerson has very smartly positioned itself to ride these huge global waves of change. They're providing the essential automation tech for, well, pretty much everything. The electrification of our world, energy security through things like LNG, the whole trend of nearshoring manufacturing, and of course, modernizing our aging power grids. They are right at the heart of these gigantic global shifts. But it's not all smooth sailing. To get the complete, honest picture, we have to look at the challenges. We have to understand the reasons behind that revenue miss. So let's just tackle those headwinds head on. The main culprit for that revenue miss is something they're calling an accounting headwind. Now, I know, that sounds super complicated, but it's really just a temporary issue. It's all about when the money gets counted, not if it gets counted. And it has to do with how they record revenue from software contracts. Here's an easy way to think about it. Imagine a magazine subscription. In the old days, maybe you paid for 2 years all at once, upfront, and the magazine company could book all that revenue right away. But now, you, the same loyal customer, decide to switch to a monthly payment plan. See, the total amount of money is the same, but it just shows up on the books in smaller chunks over a longer period of time. So the key takeaway here is this is about the timing of the money. It's not about lost business. And we're not talking about a rounding error here. Emerson put a clear number on this. This accounting shift is expected to knock about $120 million off their reported revenue for the full year. So that tells you the underlying business is actually a lot stronger than that top-line number might suggest. The other headwind they're facing is geographic. I mean, there's a really clear divide in how they're performing around the world. North America and India are absolutely on fire. Orders are up 18 and 22%. But then you've got this ongoing softness in Europe and China, where things are down, especially in big markets for them like chemicals and automotive. Okay, so you've got this mix of incredible strength in some areas and some very specific weaknesses in others. So what's the view from the horizon look like? Let's take a look at Emerson's outlook and see how all of this connects back to their long-term game plan. The CEO's own words really sum it up perfectly. They've bet the company's future on tying themselves to these huge global growth trends we talked about earlier. Their confidence comes from knowing that they are basically providing the picks and shovels for some of the world's biggest technological gold rushes. And if you want proof, here it is. Beyond the orders they already have, their project and opportunity funnel is worth over $11 billion. This funnel represents this massive pipeline of new projects that the company is out there actively trying to win. It just shows you the sheer scale of the opportunity right in front of them. And this, right here, is the bottom line. Despite that revenue miss, despite the headwinds, management is so confident in their profitability and their underlying strength that they actually raised their forecast for full-year earnings. They're now expecting adjusted EPS to be somewhere between $6.40 and $6.55. That is a really powerful signal. So it really all boils down to this, doesn't it? Emerson has hitched its wagon to some of the most powerful tech shifts of our lifetime, everything from AI to electrification. The big question for everyone watching is whether those powerful tailwinds are going to be strong enough to overcome the economic headwinds blowing in from places like Europe and China. And that's the story we're all going to be following.